Hi, my name's Adam and welcome to the channel. Today we're going to talk about tax-free savings account for beginners. In this video we're going to cover off contribution limit, how a tax-free savings works and what a tax-free savings account is, and how to maximize the account to take full value on the tax-free basis of it. The content of this video is so important because it's going to teach you how to use your tax-free savings account to maximize the tax-free value of investing. Unlike other accounts where you have to pay tax on any gain, the tax-free savings account allows you to grow your account in a tax-free manner. So let's learn how to maximize that benefit. At the end of this video, I'm going to show you how to most effectively use your tax-free savings account and how we've worked with our clients to maximize their accounts over the last 15 plus years. The TFSA stands for tax-free savings account. So what is tax-free? It means you have the ability to invest in a stock, bond, GIC, whatever it is, some sort of investment tool that can grow, and any future growth is going to be able to be redeemed on a tax-free basis. Let me use the example of Shopify. Let's say you bought shares of Shopify back in 2016 for $34 a share, and you bought 100 shares. Fast forward to today. Shopify stock is trading at $1,400 per share. So all of that growth from the $34 per share up to $1,400 per share, all that growth would have been able to be redeemed if you had invested it in a tax-free savings account on a tax-free basis versus investing it into a non-registered investment account. You would have had tax due on that gain in the form of a capital gains tax. So you can see the value of a tax-free savings account. Tens to possibly hundreds of thousands of dollars saved in taxes just by using the right account to invest for long-term savings. I want to quickly go through the eligibility of a tax-free savings account. So the tax-free savings account came into existence in 2009, and you have to be 18 years of age or older to be able to use the tax-free savings account. So anyone born 1991 or earlier, you'd have a full $69,500 in contribution room currently in 2020. If you were born after 1991 or have put money in and out of a tax-free savings account and are not sure of what your contribution limit would be, you can find that on the CRA website. So if you go through, you can find both your RRSP and your tax-free savings account contribution limits on the CRA website. Just cross-reference it with the current counts you have and ones you've had in the past, just to make sure they're all listed there. What we've noticed with some clients is that the CRA website is not updated until about halfway through the year once your tax return has been filed. So it may have missed the previous year's contribution and redemptions and also the current year contribution and redemption. So just cross-reference it to make sure that it's accurate in the data. Always keep in mind, tax-free savings account contributions are after-tax money. So you don't get the tax break going into a TFSA, but again, you get to pull it out tax-free. But do remember that you do not get a tax slip for contributions made to a tax-free savings account, nor will you get a tax slip when you redeem money out of the account. One disclaimer on your TFSA account: if you have US stocks that pay dividends, the US government does hold back 15% of any dividends paid from US corporations. So just keep that in mind. Personally, and for most of our clients, we still will invest in US stocks that pay dividends within the tax-free savings account, even though there is a 15% withholding tax. That's the only tax you're going to pay on that money, and we still think there's value in holding some US stocks in your tax-free savings account with a 15% withholding tax, but something to consider as you build your tax-free savings moving forward. Now let's go through how withdrawals work. Currently, if your maximum contribution limit is $69,500, let's say you invested that into your tax-free savings account, and at the end of the year, it was worth $80,000. So you've made just over $10,000 in gains. If you were to redeem that $80,000 before December 31st of this year, you would get all that contribution room back on January 1st the following year. So again, your $80,000 you pull out, let's say on December 20th, come January 1st, you would get $80,000 in contribution rooms back into your tax-free savings account, plus any new contribution room for that calendar year, which next year, 2021, will be $6,000. So you would have $86,000 of contribution room going into 2021. So the ability of growth to be redeemed out of the account actually gives you more contribution room down the road. So you don't lose contribution room like you would in an RSP. A TFSA contribution room will continue to grow as your investments grow over time if you make a redemption out of the account. Now let's assume you invest the $69,500 and you don't need to pull it out for any reason, and it keeps growing and growing and growing. Basically, new contribution room would be on January 1st of each year. In 2021, again, it'll be $6,000, and that will continue to grow by $500 increments with inflation. Going back to the $69,500 contribution room, if you've never used your tax-free savings account and you were 18 years of age in 2009 or older, then let's say you've put in $10,000 right now into your tax-free savings account, and it doesn't go up, doesn't go down, and in a month from now you need it and you pull it out of the tax-free savings account, you could still put in an additional $59,500 in this calendar year. Come January 1st, you'll get an additional $6,000 of contribution room in January 1st, 2021. Plus, you'll get back your $10,000 that you put in and subsequently withdrew from your tax-free savings account. So on January 1st, if you did $10,000 in, $10,000 out this year and no other contributions, on January 1st, you would have your $69,500 plus the additional $6,000 for $75,500 contribution room. Now I want to go through the misconceptions of a tax-free savings account, and there are a lot of them. And a lot of that reason is because of the banks and how they've marketed to the general Canadian public on how to use a tax-free savings account. If you walk into your bank, they're going to set up a tax-free savings account and invest it into a high-interest savings. What this means is that your account that has the potential to grow tax-free is going to be sitting in an investment that earns between 0.1 and maybe up to 1% at current interest rates. So earning that 0.3, 0.4, 0.5% on your money, who cares if it's tax-free or not? The tax benefit is almost gone because your rate of return is so low. So if you put $10,000 into a high interest savings account at 0.3%, you're earning $300 a year. Yes, you save a bit of tax on that. It's not the way the account was originally created to grow long-term on a tax-free basis. One of the other misconceptions that people have is that you can only have one tax-free savings account. That is not correct. You can have many, hundreds of tax-free savings accounts as long as your contributions don't exceed your limit. If you exceed your contribution limit, you will be penalized at 1% per month in overcontribution. So if you overcontribute $1,000, you're going to be dinged 1% every single month on that $1,000 of overcontribution. So make sure if you do overcontribute by accident to take it out right away. Lastly, I want to go through some tools and techniques on how to maximize your tax-free savings account. And we've used these tools for our clients personally, and it's worked exceptionally well. The first way to maximize your tax-free savings is to think of it as a long-term retirement solution. So when you invest in your RRSP, you're thinking about retirement and saving for long-term income generation. Your tax-free savings account, or at least part of it, should be viewed the same way. Use it as a retirement income source. So you want to start building your tax-free savings account month after month or year after year to build up a nice nest egg for retirement. The reason why you want some tax-free savings in retirement is for the larger purchases. So let's say in retirement you need to buy a new vehicle, which is going to happen. So let's say you need $20,000 for a vehicle in retirement. If you only have RSP money, you would have to pull that $20,000 out of your RSP, which creates a taxable liability and also increases your income, which could claw back old age security. If you have $20,000 sitting in another bucket in a tax-free savings account, you could pull that out tax-free, and it doesn't drive up your income to potentially claw back some of your government benefits. The second way to maximize and utilize your tax-free savings account is for your higher risk investment. And what I mean by this is play money. Now, I don't mean put $69,500 into penny stocks. What I mean is if you have an itch to put a bit of money in the stock market that you're willing to lose. And what I mean by this, it shouldn't be more than $5,000 or $10,000. A tax-free savings account is the best way to do that. So if you invest into a tax-free savings account and buy some stocks, If the stocks, let's say we use $10,000, go up to $100,000, it's not only increased your tax-free savings room, but it's also allowed you to gain $90,000 in growth on a tax-free basis. On the flip side, the risk of that is if your $10,000 goes to zero, you've now lost permanently $10,000 of contribution room that you will never get back. So you got to look at both sides, risk reward, and that's where I think a small piece could be used if you have that itch to play the stock market on your own, to have a little fun with maybe some fun money. That's the best way to do it, is to put a bit of money into the stocks that you want to buy that you think have great upside, but just understand the downside of forever losing that TFSA room. The third and last strategy to maximize and use your tax-free savings account most effectively is to not invest it into a high interest savings account. Like I mentioned earlier, the banks do a great job at pushing the high interest savings account as an investment tool within your tax-free savings account. It doesn't make sense. The only time tax-free makes sense is if you're actually earning money. And currently at 0.3, 0.4% on your high interest savings, you're not earning enough money to even get the benefit of the tax-free. As you start to maximize and utilize your TFSA room, don't waste that room on 0.3 and 0.4% interest rates on your high interest savings. Let those sit in a non-registered account, pay the small amount of tax every year that you need to pay, utilize your tax-free savings account for long-term growth. Thanks for watching. Make sure to hit the like button, and if you haven't already, hit the subscribe button, because we'll have new videos coming out every Tuesday on financial planning for your everyday Canadian.